So welcome everyone, I think, to our long-running series here of PPP updates. We try to space these out. We get requests, from time to time that we should do these more often. My sense of it is I try to wait for there to be enough material to kind of make it worthwhile to everyone. We could do them, more often, but I think there'd be more fluff. So that's why there's been a couple of months in between. There have been kind of a trickle of updates, but once I feel like, or once as a group, we feel like there's enough here to present on, then we put on these webinars. So appreciate everyone attending and everyone figuring out that it's 11 a.m. Central Time and not 11 p.m. Central Time. So for those who don't know me, Adam Sweet, I'm a principal with Eide Bailey's National Tax Office. I sit in Spokane. My primary focus is really partnership and S corporations, but I'm also part of our SBA working group and specifically our PPP working group. And I've kind of led the charge on these webinars over the last 8 to 9 months. So with that, let's launch in. eidebailey.com/PPP. It should have all of our webinars to date, as well as our insights and articles. So if you're ever looking for past material, I get questions from time to time that says, where's your old webinar? You should be able to find it there. The one caveat I'd say is some of our webinars are now out of date. Some of our early webinars back in April or March may be talking about, an 8-week covered period or 75% needs to go to payroll. And that was guidance as it existed at that time. And of course, things have changed since then. So same thing for the articles, just be careful if you're looking at an insight or a webinar, whether it's ours or someone else's, check the date because there could be out of date information there. So today, kind of an outline of what I'm hoping to cover. I think the first thing is to cover PPP expenditures and whether they're tax deductible or not tax deductible. Also, a quick review of the loan eligibility rules. This has come back up in a couple of different places. And a review of the affiliation rules. Again, it's become relevant again. I think people forgot about those after they first applied, but suddenly now when people are preparing to apply for forgiveness, these things are coming up. Change of control rules. This came up from the SBA a couple months back. So this change of control would be you have a PPP loan and you're looking to sell your business, whether it's equity or assets. What do you do? Updates on loans. If you have a loan of $50,000 or under, there's a greatly simplified process that should make it much easier. And then finally, just a couple of reminders. Nothing new, but reminders of maybe kind of tricky rules that people forget about and that we see come up in our practice from questions. So tax deduction, some of this is going to be review. We've talked about this in the past, but the CARES Act, which is the legislation passed by Congress and signed by the president back in March, stated that if your PPP loan is forgiven, that it's not taxable when it's forgiven. And that's an exception, generally speaking, under general income tax principles. If you have a loan and it's forgiven, it's income when it's forgiven. So most of us assumed that the PPP expenditures would be deductible. Why? Well, Congress clearly intended for there to be a tax benefit. They said that it's not income when it's forgiven. So we just assumed it'd be deductible because if the expenditures are not deductible, it takes away the tax benefit. And why would Congress have excluded the forgiven loan from income? It kind of seemed illogical. In fact, it still seems illogical. So we had a notice come out back in April where the IRS stated, irrespective or regardless of what Congress stated, qualified expenditures are not tax deductible. And there's kind of a long tortured logic that the IRS went through with that. They equated it with tax exempt income. There's a line of authority out there, both statutory and court, where the IRS and the courts have stated that if you have tax exempt income, because it's tax exempt, the expenses that are associated with it are not deductible. I don't necessarily agree that a PPP loan is equivalent to tax exempt income, but that's what the IRS said. They put it out there. So then the question came up, that notice that I just referenced wasn't specific to a year. And indeed, I think that the IRS, when they put that notice out back in April, were assuming that most people would have their PPP loan forgiven in 2020. Made sense because at the time it was an 8-week covered period. There was no such thing as a 24-week covered period. So most people, if they got their loan in March or April, it would have been June when their loan, when the covered period ended, they would have been applying for forgiveness. Their loan would be forgiven by the end of the year. And of course, subsequent statutory updates made it a 24-week covered period. So many more borrowers now won't have their loan forgiven in 2020. It'll be 2021. So the commentary out there, the kind of tax commentary or the Twitter commentary was, well, would it be possible to take the deduction in 2020 if you don't get forgiveness until 2021? And the logic behind it there was, well, I have a PPP loan. It's true debt. I'm on the hook for it. It's not forgiven in 2020, so I don't really have any tax exempt income, quote unquote, in 2020. So why can't I claim the deduction then? That it seems like I could maybe still comply with the notice and claim the deduction in 2020, even if my loan isn't forgiven until 2021. And in fact, some advisors, I wasn't necessarily there, but some advisors were recommending people wait to apply for forgiveness until 2021 so as to claim the deduction in 2020. Well, the IRS was well aware of this, of these questions and then what these commentators were suggesting. And perhaps not surprisingly, the IRS said no. It issued a revenue ruling and then a revenue procedure. The revenue ruling is 2020-27. And basically what it says, I'm going to summarize it here, but it says if you expect forgiveness on your loan, whether you apply in 2020 or 2021, if you expect forgiveness, your expenses are not tax deductible on your return, either for 2020 or 2021. So your wage expenses, your rent, your utility, all those expenses that you put on your forgiveness application, if you're expecting forgiveness, which I would say most borrowers are, most of our clients are, in fact, maybe all of our clients are. I don't think very many people incurred the PPP loan expecting that they would term it out and pay it off, that most of them are really expecting forgiveness, which is why they went into it. So the IRS says categorically, full stop, no deduction. So it doesn't matter if you apply in 2020 or if you apply in 2021, if you expect forgiveness, no deduction on your 2020 tax return. Along with it, there was a revenue procedure. So what the IRS anticipated here was there may be people, you may file your return, your 2020 tax return expecting loan forgiveness, and maybe you run into a hiccup next year where the SBA challenges you on something or a lender challenges you on something, and only half your loan is forgiven, and the other half is not forgiven. It's termed out and you pay it back over 5 years. What happens there? Because you disallowed all of the expenses on your 2020 tax return, yet now you didn't get forgiveness. And so what the IRS said is you could go back, you have a couple of different options. You can go back and amend your return for 2020 and claim the expenses. You could also claim it on your 2021 tax return, claim those expenses. So there could be some planning involved there, that if you apply for forgiveness and your forgiveness is denied in whole or in part, there could be some planning there that, do you want to go back and amend that return for 20 to claim the deduction? Or for 2021, do you want to claim the deduction? Maybe you have more income in 21, maybe less income in 21, so you want to claim that deduction on your 2020 tax return. But bottom line, at least according to the IRS, is if you expect forgiveness, no deduction on your 2020 tax return for your PPP expenditures. Now, this doesn't mean all expenditures. These are just the expenditures that give rise to forgiveness. But regardless of when you apply, whether it's now, whether it's next year, no deduction, at least according to the IRS. So this brings up kind of a host of questions. I mean, I think one question is, there are fiscal year tax returns that have already been filed. We had clients with a 6/30 year end. So their tax year end was July 30th, 2020. They took out a PPP loan in March, and they've already filed their tax return. And maybe they claimed the deduction on their tax return under the theory that the loan wasn't forgiven until their next fiscal year. Maybe they just weren't thinking their loan was going to be forgiven at all. So regardless, it was filed, that fiscal year return, if it was filed before 2020-27, the question is, do you have to go back and amend? I think what the IRS has said, yes, the IRS views this as regardless of your calendar year or fiscal year. I might take a little bit of a more nuanced view. I think there's some tax authority out there that states you can be grandfathered in, that all you can be, generally speaking, when you file your return, you can only be held responsible for the law and guidance as it exists at that time. And if a subsequent revenue ruling comes out that changes the law, that you're not necessarily forced to go back and amend. So it could be more nuanced maybe than what the IRS puts out there, but food for thought. And then also just further congressional action. I think Senator Cornyn out of Texas, and I think Senator Grassley in Iowa, both have stated that the original intent was for PPP expenditures to be tax deductible, and that they think the IRS is wrong by denying the deduction. So what may happen if we're fortunate is, as part of a COVID round 4 relief bill, they may explicitly provide that PPP expenditures are tax deductible. So, from a practitioner standpoint and from a taxpayer standpoint, I think we'd hope we'd get that guidance before the end of tax filing season next year. So before April 15th or March 15th of next year. Maybe in December, they have to pass a bill that funds the government for the rest of the year. I think it's December 11th or 12th. Don't quote me on that, but maybe they'll slip something in as part of that to make it tax deductible. I would say I was hopeful, but I've been hopeful for this fix for the last 6-7 months, and it hasn't happened yet. So, who knows? Who knows exactly? And then finally, I would say there's some people out there, I'm not saying it's Eide Bailey, I'm not saying it's me, but there's some people out there that think the IRS is just wrong, and that it's potentially possible to take a position on a tax return contrary to Rev Rule 2020-27. Now, you would need to disclose it, and kind of you'd have to probably really think out what your position is, because this is going to be a pretty obvious audit target. That when an agent, if you get audited in a couple of years' time, it seems pretty clear to me one of their tax 101 questions is going to be, did you have a PPP loan? And if you did you claim the deduction on the return? So you're going to really want to think about it first. But there's some people out there thinking that the IRS just is wrong on this, and that they're going against the statute, and that therefore there's a position to take. And I think you could find articles if you just did a Google search. There's been some articles out there where you could learn further. So I'm not saying Eide Bailey's there. I'm not saying I'm there necessarily, just something to think about. So kind of a corollary here, and just some background first. We've stated, I think in past webinars, that we believe that you could submit expenditures exceeding your PPP loan balance. That was our interpretation of the forgiveness form. That if you look, you can tally your total expenditures and they can exceed your loan balance. And this is really a borrower-friendly rule, because then if you've had any FTE reductions, or if you've reduced people's salary, applicable employees' salary above 25%, that can go against your total loan expenses, and you can still arrive at a net forgiveness number that is in excess of your loan. So that is indeed confirmed, kind of indirectly, in an interim final rule, where there's a question posed, and the government, this is how they do it in Q&A, they pose a question and then answer it. And then the question is, what does a lender do if a borrower submits documentation of eligible costs that exceed a borrower's PPP loan amount? And in short, what the interim final rule suggests is, first, it confirms that this is possible, so that it is a borrower can submit expenses exceeding their loan amount. But then it says, from the lender's perspective, that the lender only needs to confirm enough expenses to give rise to total forgiveness. So if your loan's $100 and you've put $200 of eligible expenditures on your loan, or on your forgiveness application, the lender only needs to confirm up to the amount of expenditures to give rise to full forgiveness, which would be $100. So they don't need to confirm the rest of it. So in a way, that's nice, because the SBA confirms what our theory was, that your expenditures can exceed your loan, but then it also raises some other questions. And here's just a few of them. So there's some ancillary considerations here. If your PPP expenditures are truly not tax deductible, there are other tax benefits, let's call them, that directly tie back to certain expenditures incurred by a taxpayer. One such item is Section 199A, the deduction for qualified business income. If you receive a K-1, you've probably seen this. What this does is it's a 20% deduction. It can lower your effective rate by as much as 8 or 9 points, potentially, if you have QBI and all the right things. It's more complicated than we'll get in today, but the deduction is not unlimited. It's tied, there's a limiting factor that equates to the wages that are paid as part of a business. So the question there is, if you paid wages with PPP funds and those wages are not deductible, does that mean those wages are or are not relevant for 199A? The 199A statute doesn't say that the wages need to be deductible. It just says attributable, I think is the language. But then in the 199A regulations, they talk about tracing the W-2 wages are allocated based on how the deduction's allocated. So uncertain. Another uncertainty is the R&D tax credit. There's the research and development tax credit, and I'm not an R&D expert, but a portion of it can tie back to your payroll and deductible payroll. So if your PPP expenditures are not deductible, you potentially lose the R&D tax credit for those wages that are disallowed. And then also state tax apportionment, one of the factors, and again, I'm gonna really expose my ignorance here. I am not a SALT expert, but I think traditionally state tax apportionment, one of the factors is where the wages are deducted. And if they're not deducted, does that somehow throw off state tax apportionment? All of these, I would say, are a bit of an unknown at this point. You know, the first two there, the QBI and the R&D, the IRS, that's in their court. And I wouldn't be surprised if they give us additional guidance later this year. And I wouldn't be surprised if they say it's bad news for both the R&D and 199A. That would seem to be consistent. You know, state tax apportionment, that's really more of a state-by-state issue. So we'll see what states come up with there. But back to the previous slide where we know that you can submit qualified expenditures exceeding the loan amount. The question here is, can you pick and choose which expenses go towards forgiveness? So if you have a whole bucket of expenses that are wages and rent and utilities and what else? Mortgage interest, different types. Would you want to put more of your expenses towards the non-wage category so that you can claim your wages didn't generate forgiveness, and that therefore you can use the wages for QBI, for R&D purposes? I guess state tax apportionment, it probably depends on where you're at, whether you want the wages to be included or not. But does that work? And it's a bit of an unknown because, again, that previous slide again said you can put a whole bunch of different expense categories on your application. The lender just has to tally up the amount it needs to get forgiveness. So does that mean when you get forgiveness, you, the borrower, can say, okay, it's this bucket of expenses that gave me forgiveness. These are the expenses I'm not going to deduct. The other expenses that I put on the forgiveness application, I'm going to say are deductible because they didn't give rise to forgiveness, and therefore I can get the QBI deduction or I can get the R&D tax credit on those items. You know, you can't see my hands, I put my hands up in the air. It's a bit of a who knows, but you know, if the IRS doesn't weigh in here, there may be some room there to play, let's say, in a way, with taxpayers and their advisors, that there may be a way to negate some of the harsh effects there for the R&D tax credit or for the QBI deduction. And then really finally is, and this is more food for thought, is just how the heck will the government, and I guess the government, I mean the IRS, track and administer all of this? And the reason why I say that is the IRS put out an announcement a few months ago that said that lenders, when they forgive the loan, do not have to issue an information statement to the borrower. So typically, if I borrow money from a bank, from Big Bank Co., if I borrow $1 million from Big Bank Co., and then you know, I go into bankruptcy and the loan is forgiven, they issue me a 1099 that says, or 1090, I may have the form wrong, but basically they issue me a form that says your $1 million loan has been forgiven. We've reported this to the IRS, so that the IRS is going to expect to see this some way, somehow on your return accounted for. For PPP loans, lenders do not have to submit this form. And the reason why the IRS said this is because the loan itself, when it's forgiven, is not taxable, and the IRS was concerned that if suddenly a bunch of forms are filed with the IRS by banks saying a PPP loan is forgiven, the IRS may, get its wires crossed and be expecting income to be forgiven, or be expecting income to appear on a return where it shouldn't. But then the counter to this is, how will the IRS even know that someone had a PPP loan? So if I have a whole bunch of expenses on my return that are the same as any other year and I claim a deduction, how's the IRS going to know that I had a PPP loan or didn't have a PPP loan? And the short of it is, I don't think the IRS will know necessarily, unless they somehow cross-reference tax returns with SBA records. So, kind of further food for thought of it may be a big mess in the next couple of years for, if people are aggressive, or really more likely people that are just confused and claim a deduction. Uncertain to me how the government and how the IRS is going to really administer this. So switching gears a little bit here, backing away from the deduction, whether or not it's deductible. Separately, there's been this issue all along on loan eligibility. And if you go back and read the statutory text to the CARES Act, which created the PPP, the program itself, the Paycheck Protection Program itself, all a borrower was required to do in order to get a loan is that they had to certify that the loan was necessary to the uncertainty of the current economic conditions caused by COVID, that they'll use the funds, to retain workers and maintain payroll, and that they're not receiving duplicative funds for the same use from another SBA program. So if we rewind back to March, most of the known world, or I joke, but really the United States anyway, most states and cities and municipalities were going into some type of lockdown. And I think every industry was legitimately wondering what's going to happen next, whether you're a restaurant, whether you're construction, whether you're a manufacturer. No one quite knew what was going to happen. The market had dropped by a third. So really, I think most borrowers in good faith were able to sign this if they applied for a PPP loan, because really they're like, there wasn't a room for a ton of abuse, because you had to use the funds to retain your workforce. And pretty much everyone could say that they're affected by the uncertainty caused by COVID. And really, there was nothing in the statute that talked about access to other sources of liquidity, owner equity, et cetera. When you filed your original loan application, you only had to hit these 3 sub bullets. There was nothing else there about, you didn't have to check a box that said, I can't get a line of credit from a bank, or I can't ask my owners for additional capital. So this is kind of a rewind, but there was a bunch of bad press in April and May about large borrowers, very public borrowers. I won't name names, but even publicly traded companies received loans. And there was some really harsh criticism of the SBA. And so in reaction to that, the SBA created kind of rules after the fact and tried to say, well, as part of that original certification, borrowers should have been taken into account whether they could access other sources of liquidity. And I call it the ongoing saga. There was a whole bunch of FAQs, if you go back and look, that created a bunch of uncertainty for borrowers. And it was really unfortunate, because a bunch of people were scared in a way and worried that they needed to give the money back somehow. And what the SBA finally said was, if you had a loan of under $2 million, they were going to deem you to have borrowed the money in good faith, and you didn't have to worry about necessarily what questions the SBA may ask. What the SBA said, though, if you're over 2 million, that it would be reviewed by the SBA, and that ultimately, if the SBA challenged you on it, you may have to just pay the money back. So it's not even that the loan wouldn't be forgiven, it's that you just have to immediately write a check back to the SBA. But what we didn't know is, what would that review look like, or how would really the SBA administer that? And we now do know there's a form floating around out there called the Form 3509, which is for profit borrowers. The analogous form for nonprofit borrowers is 3510. And it's for people that received a loan of 2 million or greater, including affiliate loans. And the way this works is, you submit your forgiveness application, and then if it's applicable, the lender sends this form to you. and you have to fill it out and send it back to the lender within 10 days. Now notice at the very top, well, not the top right, but medium top right, there's an expiration date of 10/31/2020. That'll become relevant here in a second. So I just highlight that there for you. So there's a whole bunch of questions on this 3509. I've listed just a few of them. And again, this is coming from your lender to the borrower, and the borrower has to answer all these questions. So, you have to list your 2019 and 2020 gross revenue figures. You have to detail how you were, if you were shut down, how you were shut down by COVID-19, governmental order. You have to list your capital expenditures, whether you took any capital improvement projects between March 13th and the end of your covered period. It's about hinting there that it would be inappropriate if you're able to, undertake a capital expenditures that you somehow didn't need the PPP loan. Some additional questions there in the 3509. There's a liquidity assessment that you have to list how much cash on hand you had at the time of the loan, owner compensation if you paid any owners in excess of 250 grand, or other governmental aid. Did you get an Eide loan? And there's other questions as well. This is not meant to be an exhaustive synopsis of the 3509. I would just say a lot of it's uncertain how these questions will be used. Will they be weighted? Who's gathering all this information? If you've had the form, you've probably had the same questions I had. Is, well, I'm going to fill all this stuff out, and who uses this? We don't know at this point. It's also unfortunate because none of these questions existed when you incurred your loan originally. So if these were all relevant, like owner compensation, for instance, this was relevant, they should have had it on the original application, and they should have said, if you take this loan, you can't pay an owner employee more than 250 grand, annualized rate during the covered period. I think it's very poor policy to create these rules 8-9 months later, but it is what it is. There's been a lot of pushback on this 3509. The AICPA sent a letter a couple of weeks ago to the government. I think different industry groups have as well, making the same points I just made, that it's very poor policy to retroactively create these rules 8-9 months later when borrowers incurred the loan and then used the loan to maintain payroll. And in the absence of the PPP, they likely wouldn't have maintained payroll. What would a lot of borrowers have done? They probably would have let employees go temporarily, go back to unemployment. Unemployment was pretty generous back in March and April and May with the additional federal kicker involved. I think it was close to $31, $32 an hour until June 30th. So what a lot of borrowers would have done logically is, let's just say you're a manufacturer and you're shut down for a month. You would have sent your workers home for the month. They would have been on unemployment, which is unfortunate. But from a business perspective, you would have done that to conserve cash flow. And really, that's irregardless of if you had owner equity or if you had cash on hand or a line of credit. Prudent business would have said, no, we preserve cash flow. Well, the SBA had this PPP program that said, we'll basically give you money that can be forgiven if you maintain your payroll. So in good faith, lots of businesses said, okay, we'll borrow this money, we'll maintain payroll. The government's kind of induced us to do this or encouraged us to do this. And now 9 months later, the government's somehow threatening to take this money away. And oh, by the way, you can't go back and undo what you did in March by maintaining full payroll. That's cash out of pocket at this point. So it's poor policy. And I'm usually, I used to work in the government, and I understand the government's predicament in many situations. I don't understand this particular predicament. But if you receive the 3509, what can you do? Well, as I highlighted before, there's a version of the form that expired as of 10/30. So the first thing I do is ask for an updated form from the bank, from your lender. And then secondly, if you receive it, there's really no prohibition against providing explanation and documentation. There's all these questions. Some of them are open-ended. Some of them are ambiguous. So I think you could narrowly construe the questions and then provide explanation and documentation. And then finally, there have been anecdotal stories of borrowers with loans under 2 million receiving this form as well. I heard of one story, I didn't hear it directly from the borrower, but someone with a loan of $800,000 received this form. Again, I don't have official confirmation that happened, just anecdotally, So just put it on everyone's radar. This form is floating around out there. It's very detailed. You won't be happy if you get it, but some things to think about if you do get it. And then I'd just say talk with your advisor when you get it and kind of game plan how to answer those questions. So this is kind of a piggyback to that 3509. What triggers that 3509 is when you apply for forgiveness. This is a copy paste from the forgiveness application, and I'm sorry, it's small, but if you see the red arrow I created at the bottom, there's a box you check that says that if you receive PPP loans in excess of 2 million, you check that box. I think that's what triggers that 3509 being sent to you. But notice in parentheses what it says there. It says if borrower together with affiliates, if applicable. And we've recently run into more than a few borrowers where we've had to relearn these affiliate rules, let's say. So I thought it'd be a good topic today that as people apply for forgiveness, these affiliation rules may come up again. And so just a quick review may help there. But what does it mean to be affiliated? Well, what it means to be affiliated for PPP purposes is multiple businesses could be treated as a single borrower for PPP purposes. So if you remember back that PPP, one of the eligibility requirements was 500 or fewer employees. If you have two businesses that each have 400 employees, if they're affiliated, they're deemed to be 800 and they're not eligible for the PPP. How do you determine affiliation? It's kind of a loosey-goosey test, facts and circumstances test. The SBA put out not an FAQ, but an interim final rule on affiliation. You generally look to common control or ownership or management. I would just say the rules are generally broad in nature and they're not cut and dry. So typically in the tax world, related party, we say more than 50% common ownership, using the rules of attribution. They're not as cut and dry for the SBA world. So you could actually have less than 50% common ownership, and you could have businesses that are deemed to be affiliates of each other and under common control. But we're not going to go too far into that today. But suffice to say that if you are affiliated, it could be an issue because you're treated as a single borrower for PPP purposes. So then we get to the exception, of course. And the two big exceptions to the affiliation rules were businesses with an NAICS code beginning with 72. So this is generally people in the hospitality industry, restaurants, hotels, and so forth. If you think about it, the example I use here is if you think about a national hotel chain, they're likely affiliated under traditional SBA guidance because there's some common management up on top. Let's just say it's Hilton or Marriott. That there's probably some common governance where Hilton or Marriott corporate can control certain things. And it may be enough that all the different Marriott or Hilton hotels in America are treated as would be treated as a single affiliated borrower. Well, so that's why if you have this NAICS code 72, you're exempted from that. So each of those hotels could stand on its own and apply for the loan as long as it had no more than 500 employees at the particular business. They created this, anticipating that the restaurants and the hotels and the hospitality industry are going to be particularly affected by COVID, which they have. So that's why they created this exception. And then the other exception is if you're a listed franchise. So the SBA maintains a franchise list. If you're a franchise on that list, the waiver is also affiliated. So if you're a Ford dealership, again, Ford probably has enough common control where you could argue that all Ford dealerships in America are affiliated, but the SBA rules say, well, that's true under general principles, but we're going to create this exemption here so that a dealership can apply. So this is an example from the FAQs that the PPP or that the SBA put out. And you have X, Y, and Z, and we're going to treat them as affiliated companies. Y is exempt. Let's just say, so I think under the facts, Y is a restaurant, but you could call it a hotel, call it a dealership. Z is not exempt. So Y has 400 employees, Z has 400 employees. And cutting to the chase, what the example says is Y could apply for a PPP loan and is eligible, because even though it's affiliated with Z and X, it stands alone. However, Z is not exempt. Z is a construction company. So Z is affiliated with Y and X, and Z would have to include Y and X's employees for its PPP loan, which would have put it over 500 employees. Even if it was under 500 employees, Z, when it fills out its forgiveness application, would have to include X and Y's loan amount when calculating whether it has a PPP loan in excess of $2 million. So stated a different way, let's say Z borrowed $1 million, Y borrowed $1 million, and X borrowed $1 million. Z might be thinking it's in the clear because it only borrowed $1 million. Not so fast because it's affiliated with X and Y, so it would be deemed to have a loan of over $2 million. I will warn too, we've seen it in a couple of cases. It's unfortunate, but we've seen it in a couple of cases where Z, we'll just stick with Z for instance. Z applied for a loan back in March. Z said, we only have 400 employees. We're eligible for a loan. And they put it on the forgiveness application. And they received a loan from the bank. And now they're getting ready for forgiveness. And they come to us and we're helping them with the application. And we say, well, wait a minute, you're affiliated with X and Y. And you had more than 500 employees at the time you applied back in March. You know, it looks like perhaps that you're not eligible for the loan originally. And it was not, there was no intent on the part of Z to, circumvent the rules. It just happened. Things were moving so quickly back in March that you submitted your loan application. You said, hey, I'm under 500. There's this affiliation question. I don't know what that means exactly, but I need the money right now. Otherwise I'm going to lay everyone off. So I got the money. So that's a difficult situation right now where suddenly you're going in for forgiveness and you're going to confront this problem. I've seen it a couple of times and I don't know if there's any easy out necessarily. So if this is ringing a bell for you, I'd reach out maybe after this webinar to your Eide professional or whoever you work with on your forgiveness application. This is, we'll skip through this, but this is kind of the detailed explanation that the SBA gave for X, Y, and Z, why it works that way. So you could review that on your own time. I would just say there's some other exceptions, even if you don't have the NAICS code of 72, or even if you're not a listed dealer, and if you have more than 500 employees with your affiliates, there's some other exceptions. There's a small business concern exception, and there's some other applicable size standards for certain industries. So you may not be, if I go back to this, if you are Z in this example, there may be some other things you could look to scramble. That's why I said it could be a little sticky, but there may be some answers there by pointing to a different exception. So then this brings up a related question of, and that we get this from our clients all the time, is, well, I just gave everything to the bank. I assume the bank knows what they're doing. If they approved the loan, that must mean I'm eligible for the loan. And if they approve forgiveness, that must mean I'm good to go. And unfortunately, it doesn't quite work that way. That the PPP was set up to largely make lenders not directly liable. That lenders, in many cases, can just rely upon the information given by a borrower. So ultimately, liability or issues fall back to a borrower and then ultimately the government. And the first example of this was early on in just an FAQ, where it asked if lenders are required to make an independent determination regarding the affiliation rules, and the answer is no. So if we go back to this example here, Z's could be in trouble if Z got the loan, and Z might say to us, well, hey, I just applied back in March. I listed everything. The bank should have figured it out. The answer is no. Really, the onus is on the borrower, not the lender. So it's unfortunate that I think we'd all like to say, hey, the banks are the one making all the money on this. They should have some increased responsibility in this. It's not really the way the program is set up. And then even if you take a step back, even forgetting affiliation for a second, this is from an interim final rule where it clarifies what a lender is supposed to do versus not supposed to do. And the lender, so the borrower prepares their forgiveness application with all the supporting information, dots the I's, crosses the T's, does the mathematics necessary for forgiveness, and then submits it. And the lender is really not required to do a whole much beyond that. They're obviously confirm receipt. They're supposed to do a look through on the documentation to make sure everything kind of roughly adds up. Confirm that the borrower made the different calculations. But what is the lender not required to do, or maybe more, what is the borrower's responsibility? And here's what the SBA said. They said, providing an accurate calculation of the loan forgiveness amount is the responsibility of the borrower, and the borrower attests to the accuracy of its reported information and calculations on the loan forgiveness application. Lenders are expected to perform a good faith review in a reasonable time of the calculations. So really, it's back to the borrower. If a mistake is made in the calculations, don't count on your lender catching that. And if the SBA ultimately denies you forgiveness or does a review of your loan in a couple of years, your recourse is not going to be, hey, I gave it to the lender, I just assumed they knew what they were doing. No, it's not the way the program's set up. That it's really, again, the weight, the onus, the responsibility is put back onto the borrower. And I think that's emphasized here in the second bullet point, that lenders may rely on borrower representations. So lenders aren't required to, typically if a lender is going to loan you their money, so if I go to Big Bank Co. and I want to borrow $1 million, they're going to do a whole bunch of diligence, right? They're going to, all the loan paperwork, I'm going to submit everything. They're going to do a whole bunch of follow-up because it's their money on the line. So even if I just say, hey, Big Bank Co., I promise you I'm solvent. I promise you I don't have any liens. I promise you that I've never been bankrupt. Big Bank Co. is going to say, well, that's great, but we're still going to do all our diligence. It's not that way with the PPP, because it's not, the Big Bank Co. is really not on the hook. It's the SBA on the hook. So the way they've been set up is Big Bank Co. can rely in many circumstances on borrower representations. So if I was going to sum it up, I'd say don't rely upon your lender necessarily. I mean, certainly big lenders probably are becoming more sophisticated and more experienced with the program, and they may be able to spot common issues and help borrowers, but it's not necessarily their responsibility. So you can't just say, well, I applied for the loan originally and I got it. That means automatically I was eligible. Or you can't just say, I applied for forgiveness, I was forgiven, I'm end of story, close the books, throw all the documentation away, we're good to go. Because if you are reviewed by the SBA a couple of years later, it won't be the lender, it'll be you and the SBA. And the SBA will have your forgiveness application asking you questions about that application. And you can't just say, oh, the lender, Big Bank Co. looked at it and they were good with it, so you should be good with it. Not the way the program is set up. Change of control rules. We had multiple questions from clients, borrowers over the summer who incurred a PPP loan, and then before the loan was forgiven, they were going to sell their business in whole or in part, either sell the equity of their business or sell the assets of their business. And the question was, well, what do they do? The borrower is not going to want to assume the PPP loan, but at the same time, if the loan's not forgiven, how do you account for that? Do you somehow have to escrow for it and so forth? So we had rules come out, I think this was in September, so it's November now, a couple months back, where the government finally gave us rules. And first of all, they defined change of control to mean basically 20% of the equity is sold, or at least 50% of the assets is sold in a series of transactions. And importantly, it's not just a sale, but it could also be a merger. So if you're merging one business into another, that could be a change of control. And so the first point is, for all change of control transactions, you need to notify your lender that you're going to do this. Makes sense, right? This would be the case even if forget even non-PPP world. If you have Big Bank Co. loan on your books and you're going to sell your business, likely one of your covenants with Big Bank Co. says that you must seek their approval first before you do that. So that makes sense. But what this guidance also says is, if you're going to sell more than 50% of your equity or 50% or more of your assets, not only do you need to seek approval from a lender, But if the loan is not forgiven before the transaction, you have to put the loan amounts in an escrow account with the lender. Then you could execute the sale, and then you could go for forgiveness. And if your loan's forgiven, then the escrow account would be released back to you. But certainly a pain if you had a loan of $1 million or $2 million and you're subject to these rules and you're going to sell 100% of your business and your loan's not forgiven. If you had to put your $2 million into an escrow account, not great. Even if you're going to get the money back, not great, because it might be, where do I come up with that $2 million? But it makes sense, I think, from the SBA's perspective. They're trying to protect themselves, that they're not chasing after, you know, the after the sale, they're not chasing after the different parties. And then finally, what the government said is, regardless of what you're doing, is you remain liable for your loan. You've signed for it. So even if you sell 100% of your business and you figure you've wiped your hands clean of it and you're going to go into retirement, you remain liable for your PPP loan, and you're subject to all the covenants and restrictions even after engaging in a change of control transaction. Again, this shouldn't be a huge surprise to anyone. This would be the same as if you just had big banco loan on your books. This would be the same rule, that you personally signed for it. You're not released from it until the loan is satisfied. There's more detail here in the change of control rules. If this is you, again, reach out. We have an article out there on this we put out a few months ago. You could look at that article. Or I'm sure there's other articles on the internet, or you could even just pull the change of control rules directly from the SBA, and they walk you through what you need to do. So timing, we've talked about this from time to time before. I know many advisors, before the revenue ruling where the IRS said the deduction's denied regardless of when you apply, many advisors were telling borrowers to wait to apply for forgiveness until next year. I wasn't pushing that necessarily, because I wasn't convinced that the IRS was going to differentiate between those two situations, applying this year versus next year. And I think, ideally we were proven right on that fact. But many lenders are sending notices out to borrowers saying you can apply right now, and in fact, we want you to, or you're required to apply right now for forgiveness. Why are the lenders doing it? They want to just wipe this whole thing off their books and be done with it because they want to get paid by the SBA. You don't have to apply right now. You generally have up to 10 months to apply. Measured starts with after the end of your covered period. You have 10 months to apply. And principal and interest is deferred during that time. Originally it was 6 months, now it's 10 months. So you can, if your covered period ends here on November 30th, you have 10 months. So that would be until, end of September of next year. And you won't, as long as you get full forgiveness, if you apply in September of next year, you'll have no principal or interest due. So there's no rush, and you can ignore, certainly apply for forgiveness if you're ready. But if you feel like you're receiving pressure from your lender to apply, there's no reason to give in to that. And if you'd rather wait for a couple of months to buy yourself some more time, or if your covered period is still open and you need to incur more expenditures, definitely take that time. It was purposeful. The statute gives us this 10 months. That was purposeful, I think, contemplating that people are going to need some time to get the information together, to do some planning for it. So take that time if you need it. And you can even send your lender the FAQ where it says that they're supposed to hold off for that 10 months. If your loan is $50,000 or less, there's a new form. It's called the 3508S that greatly simplifies your forgiveness process. And what it says is you're exempt from the FTE reductions or the salary reduction. So if we think back to PPP 101, the general rule is you sum your expenditures and expenditures generate forgiveness. But if you've cut your FTEs during your covered period as measured against a reference period, or if you've cut certain employees' salaries by more than 25%, both of those things can reduce your loan forgiveness amount. If your loan is $50,000 or less, you can just ignore all of that completely. Now, the one caveat here is if you're affiliated with anyone else, and if in the aggregate with your affiliates, your loan is over 2 million, then you can't use this form. I haven't seen this come up in practice. I would guess this is rare if a borrower has a loan of 50 grand or less and yet has affiliates that together have loans in excess of 2 million. But still, that rule's out there. So this is going to make it a lot easier. If you have loans of 50,000 or less, this 3508 OS is almost, I won't call it automatic forgiveness because you still have to tally up your eligible expenditures, but it's pretty darn close to automatic forgiveness. So make use of this if eligible. Questions on that, feel free to reach out. This is the EZ form. We've talked about this a few times, but I keep getting kind of similar questions. And I'll give you my take on this, and then I'll kind of give you why I'm a little confused by it. But these are from the EZ form instructions, and you have to be able to check one of these 3 boxes to use the EZ form. First, you'll notice that there's no loan minimum or maximum. So you could have a loan of $1, or you could have a loan of $10 million, and you could still use the EZ form. But secondly, if you're not, the first box is for self-employed people, independent contractors, but if that's not you, the second and the third box, they reference FTE and FTE exceptions. So if you look at the second paragraphs under the second and third box, they talk about a borrower not being able to operate at full capacity due to COVID restrictions, or employees voluntarily left and the borrower was not able to hire similarly qualified employees. Both of those exceptions, though, are for FTEs. So if you had an FTE reduction, if you could rely upon those exceptions. The first paragraph, though, is more categorical. It just says the borrower did not reduce annual salary or hourly wages of any employee by more than 25% during the covered period. And this doesn't count, employees making over 100 grand aren't covered by this, but otherwise, if you did reduce annual salary or you did reduce someone's hourly wage, remember it's any employee. This is not in the aggregate. This is not, FTEs are the aggregate, averaging, measuring. The salary reduction is per employee. If you fall into that, you cannot use the EZ form. And it's strange because in the statute, there's actually an exception to this that says if you've cut someone's pay by more than 25%, but you restore it by the end of your covered period, you're not penalized. They didn't incorporate that exception here. So it seems to be just a blanket prohibition that if you can't certify if you reduced anyone's salary by more than 25% or the hourly wage by more than 25%, you can't use the EZ form. And one other point on that, the salary would be your weekly salary. Hourly wage, interestingly, if you're paying someone $30 an hour, and they were getting paid for 40 hours a week pre-COVID, but during the covered period, 20 hours a week. But if you're still paying them $30 an hour, you can potentially check that box because you haven't cut their hourly wage. They're still getting paid $30 an hour. It's just you've cut their time total, which would influence FTEs. But then again, you may be able to say that we cut the FTEs due to COVID compliance and still be able to use this EZ form. And then finally, a related party rent. I used this example during our last webinar, but I keep getting questions here. The SBA has said that if you have an operating business that pays rent to a related business, there's restrictions on what rent qualifies as a qualified expenditure. And first, what the SBA said was any amount of common ownership makes it a related party rent. So I think that means even if there's 1% common ownership, so if you have 99% unrelated ownership, but there's 100 people, but there's one person that has common ownership between the two, I think you have related party rent. And this is strange because normally in the tax world, again, we'd be looking to 50% or more or some type of threshold. Here, it's just 1%, you have related party rent. If that's the case, the rent in this example paid by the OpCo, which is operations, the rent, the portion of it that's qualified that can generate forgiveness is only equal to the mortgage interest that's paid by the property owning company. So in my example here, OpCo pays $1,000 of rent, but there's only $200 of mortgage interest paid by the property owner. So only $200 qualifies as a qualified expenditure for PPP purposes. Harsh rule, but I think it's pretty clear that's the outcome here. And then if you're doing the math, you'd probably say, well, what if there's no mortgage? What if PropCo paid off the property 10 years ago? And this does happen quite often. Well, then the qualified rent expense would be zero because there's no mortgage interest. So none of the qualified rent none of the rent would be qualified, and it wouldn't generate forgiveness. Harsh result, I agree. Fair result, no, but I think it's clear under the guidance that the SBA put out. Yeah, so just wrapping it up here, I think thanks everyone for sticking around for this hour. Specifically here to the second round of PPP loans, I do think something will be passed. Of course, it's a question of when, whether it's this year or next year. But if they do pass it, it would allow every eligible borrower to get a second round. So just because you've had a loan in the first round wouldn't mean that you couldn't get the second round. I think the second round, though, they're going to tighten it a bit, that not everyone's going to be eligible. You're going to have to tie it back to some type of gross revenue decline. They originally talked about a 50% revenue decline, during COVID as compared to pre-COVID. I think they ratcheted that back a bit to 30%, but I do expect a second round of relief to come, particularly as states now we've had additional shutdowns. I live in Washington State, and restaurants and gyms, unfortunately, are shut down again. So they're hurting, and they're going to need this aid because it's almost like a natural disasters. It's like a tornado's come through. And so I think the aid's needed, and I think we will get it. It's just a question of when. So keep an eye out there. And with that, we're right at 10 a.m., so I'll leave it there. I know there are many questions we didn't get to. I'll look through these afterwards and see if there's any kind of commonalities there, and maybe think about an article or answering them with our next webinar. But again, I'd always encourage you to reach out to your local Eide professional. We have part of our SBA working group. We have people in each office that are part of that group. So there should be some local office expertise that can help. With that, I'd just say goodbye, and